And Trevor, before the break, you were talking about your own personal experience, and I just wanted to give you a chance to finish that up because I think it's important.
Yeah, thanks, Todd. Yeah. So, what I was saying, I finally appreciate that much more when a client says, I don't want to leave the home, and I just want this money for care.
Right.
And we do a lot of those across the country because aging in place is so important. And
that has such a value, I think. And I think people potentially, I don't know if this is true or not, but they might live longer if they can be in their own home.
Absolutely.
Yeah.
There's no
more
question.
will to live, maybe. Joie de vie.
Absolutely. And it's all in our environment. It's like, I know where everything is. I know where the store is. I know who the neighbors are.
Right.
And aging in place is very, very important.
But being able to pay for somebody to clear the driveway and mow the lawn and take care of the garden that you love is important.
Absolutely.
Or maybe even doing renovations of the home to be able to stay in the home.
Exactly. That's right.
Absolutely. And I'm actually seeing more now of the children saying to their parents, listen, Mom and Dad, I can't be continuing to come to cut the grass, and I'm
they're getting older.
Kids,
they're getting older.
Or they're getting older as well.
Yeah.
So this allows them to hire somebody to come and do that work for them.
What I'm seeing a lot, Trevor, is people wanting to get into the housing market and parents and grandparents really helping first-time home buyers getting in. And a lot of these kids, and I'll call them kids, but they're adults, need big gifts to be able to get into the housing market, because of their income and the cost of housing. I'm seeing a lot of six-figure gifts, and I read something the other day. The average gift now for a first-time home buyer to get into the housing market is something like $106,000.
Wow.
Yeah. So it's Bank of Mom and Dad.
Yep.
Mm-hmm. And in the Toronto, Vancouver markets, it's almost impossible for somebody to get in there.
They don't just need $100,000; they need $500,000 or $1 million maybe to get in.
Exactly. So Bank of Mom and Dad is a common use. Again, helping with down payments, early inheritance. What I've seen a lot of here is actually Mom and Dad helping out through a separation or divorce.
Right. I never thought about that one.
Yeah. And I think, honestly,
it's almost like they're getting their inheritance now versus later type thing.
And I think that's more for the grandkids.
Let's keep them in the house.
Nanny and grandpa want to make sure the grandkids are just down the street still.
Right.
And they're going to do what's necessary to help in this situation.
But they can't swing at a big payment.
Exactly.
And you know what? I think that's what's so amazing about CHIP is there are different methods. Like we talked a little bit on the break. The old school method was you got a mortgage, you got the money, and then you don't make any payments, and that payment capitalizes, like the interest capitalizes every month. But you were telling us about the new school way where potentially they still get a lump sum depending on, how much they can borrow, but they're also getting a monthly payment. So tell us a little bit more about that.
Yeah. So we have a few different programs. So, we could approve a client for up to, let's just say they're approved for $200,000.
Okay.
Well, they might, between their mortgage and the credit card debt, maybe they owe $130,000. So that $70,000 can come to them in a few different ways. We can set it up where a monthly income stream comes into their bank account, or the money can sit there.
So it's almost like a pension.
Yes, absolutely.
From their house.
Very, very similar to a pension. Or the money can sit there like a line of credit or a HELOC, and they can access that in the future when they need it.
Okay. Makes sense. I think that's really, something that people don't understand. And I think that has a lot of value. Mm-hmm. And, there's other ways that seniors can borrow. Trevor, I'm sure you see this. Like some seniors that come in to see us, have high net worth, have high income, and they just want a HELOC. Cool. If you're okay to pay the interest, there are other ways. Some want to get a mortgage. But what I think is really interesting about this product is it's not as driven towards credit. Like I've seen some seniors be able to get approved for these type of products, and the credit's not that great. But it's very driven on the equity and the asset it's more driven on.
Yeah, absolutely. We are an equity lender. Mm-hmm.
It's home equity bank. It's right in the name.
Exactly. And credit score, we do not have a minimum credit score requirement, but, even saying that, our average credit score is probably about 750, 760.
Okay.
So the clients...
It's strong credit.
Yeah. The clients typically have stronger credit, just they have no cash flow.
Right.
And, in my 8 years...
So they're asset rich and cash poor, really.
Yeah. And I've seen this product in my 8 years go from a need basis to a want.
Got it.
And I'm seeing a lot of deals now with the 70-something client that has $200,000 mortgage. And, the mortgage broker is saying to this client, listen, you are never going to pay this off in your lifetime. You're 74 years old and you owe $200,000.
Yes.
Why don't you look at switching it to a product that works for you, like a reverse mortgage? And, I am seeing that way more now than what I saw 8 years ago. And, and it's only going to become bigger and bigger. If we look at the people that are heading into retirement now, people that might be in their early 60s, they are not near ready. There's, record amounts of consumer debt. You talked about
I see it every day.
You talked about it earlier in this, Clinton, keeping up with the Joneses. And, the people that are coming that, have a big mortgage, big credit card debt, and, we're able to consolidate that, pay it off, and, keep them in the home. And, that's from really, 65 up and there. We can help somebody who's 55.
So 55 is like the starting age, but those ones basically, they almost need to have their home free and clear.
Yeah, usually, at least in Atlantic, what I see is typically somebody has inherited that home.
Right.
So maybe we have the 56-year-old daughter who was living in the home for the last 5 years, taking care of her mom.
Right.
Because her
hasn't
mom
worked.
Hasn't worked. Now, all of a sudden, mom has passed away. And while she has this home, she has no income.
She can't pay the property taxes. She can't pay the heat. She can't pay the insurance because really all she has is the home.
Exactly. So we're able to advance some funds to, get them back on their feet. You know, the intention is to go and find a job. But even, Clinton, if you got a 57-year-old that walked in your office today, hasn't worked in 5 years, and is 1 month on the job,
they're probably not getting a mortgage. Probably not.
Yeah. Yeah.
I'm a miracle worker, Trevor, as you know, but like my powers are limited.
That's right. Okay, I want to ask you some more about the logistics of this thing. So if somebody has a house that's worth, say, assessed at $750,000, they have a $200,000 mortgage. They're 60 years old. They got 15 years left on their mortgage or whatever.
Is it is it like a couple or is it just one borrower?
Well, say a couple.
Okay.
I guess. Okay. What can you do for that person? Tell us, paint the picture what you can do for that person.
Yeah. So we calculate what a person qualifies for based on 3 factors.
Age is big.
Age is number one.
Okay.
Mm-hmm. Location is number 2.
Okay.
We're going to lend more in a Halifax than we would in a
rural ecum-secum.
Yeah, in a rural area. Yeah. We do lend everywhere. We do not have.
I give a lot of shout outs to ecum-secum. So if there's any of our listeners down there, I'm sure they're like,
nothing disparaging.
Yeah.
Clinton's big on the Eastern Shore. It's all good.
Right.
And the third qualifier we do is just based on our own internal data.
Okay.
As I mentioned, we're
the algorithms or the actuaries.
Exactly. And that's really what it comes down to. Now,
is it true a couple normally lives longer than a single person, or does a single person live longer than a couple?
Depends on the couple.
Yeah, I mean, that's true. Now we're getting into some politics here, maybe. I'm not sure.
Well, it's funny, Clinton. We would actually give more money to a 75-year-old single male than a 75-year-old single female.
Because the single females will live longer.
Absolutely.
The couple male will live longer because they're being taken care of, maybe.
Yeah. Exactly.
Maybe we need a little drum roll there. I'm not sure.
Yeah. That's why I mentioned our average client is a widowed female.
Right.
Yeah, so we use those 3 aspects in determining the loan to value.
Okay.
So, if that comes out that, they qualify for, $150,000 and they have a $250,000 mortgage.
Doesn't work.
It doesn't work.
No.
So they need to come the traditional route.
Exactly. And that's where Clinton would work with them in another aspect.
All right. So if somebody had $750,000 worth appraised house in Halifax, they had $200,000 on their mortgage, they're 60 years old, is that a good client for you?
So yeah, I would have to guess at the loan to value on that one. A couple that is 60 living in Halifax.
Maybe too young still, I think.
My guess would be we would probably do high 20% loan to value on that.
Okay.
Yeah, so
around it up to 30 is maybe where we
so
would
they
go.
so they may be scraping to make at the 200,000. So like for me, I think a 6-year-old will be too young.
So is it safe to say that this is kind of an insurance product? Is that a safe way to describe it? Because you're talking risk here.
I mean, it's still a mortgage.
But there are variables of risk, how long people are going to live and all that stuff.
Absolutely. You know, we're taking a risk that, you, for example, let's say it's a 75-year-old.
Yeah.
If they live to 100, that might be costing you guys some money.
Yeah.
And it could.
And conversely, some might die in 2 years, not to be morbid, but that happens, right?
Absolutely.
I mean,
These
these are the algorithms that you use,
I mean,
right?
anything could happen. Like we could die tomorrow. Who knows?
That's right. So it's an insurance product based on actuarial numbers.
Absolutely.
Yeah.
And, one thing, though, Clinton just mentioned, that 75-year-old, well, what is if they live 30 years in the home? One of the, myths about our product is that, they die and we go after the estate for, any negative balance. We actually have a no negative equity guarantee.
Okay.
So that situation, Clinton, that you said that, they live for another 30 years, they owe us, 800 and the house is now only worth 700. That 100,000, we do not go after the estate on that.
Yeah.
That is in our contracts of a no negative equity guarantee.
All right. What if somebody is in ill health, bad health, and
And they move out of the house, you're saying?
yeah.
So if they go into a home, then at that point they need to sell the house. Or
If
the estate needs to pay out the mortgage.
If they're the only
person.
So if we did a deal with a husband and wife and one of them was to go into a care facility,
It's fine. No change.
Nothing changes.
Right.
Got it.
Yeah.
Right.
Or if one of them was to pass away, there's
Nothing
no
changes.
changes. But Clinton, you would know in the bank world, if somebody has a HELOC and one of the persons passes away,
They shut her down.
Yeah.
You're done.
And we have that guarantee that would never happen with one of our
Products.
clients.
All right. So hence, the younger you are, the more equity you need in order to make it attractive
Correct.
for you.
Correct.
For
And
you
the
guys.
older you are, the more money you get. So when you think about things like being ageist,
Right.
where you're like, well, we're not giving a mortgage to a 70-year-old and a 30-year amortization. Chip is like, the older you are, the more you're going to get from us.
Yeah.
We love it.
So it's the opposite, really.
Yeah, and you actually cap out so that 55% max that we will go.
Yeah.
When you're around 82.
Is the kind of, you're going to get your maximum amount of equity out when you're 82.
Exactly.
And the minimum out when you're 55.
Correct.
Yeah.
Okay.
So
interesting.
Trevor, there's a lot of layers to this, right? I think we just scratched the surface. It's fairly complex, but I think people who are listening are enticed and get some of the benefits. So if they want to know more, you're the person to reach out to. How do they get a hold of you and get all these details?
Well, number one, I would recommend they contact Clinton.
Yeah, because we can see if this is even going to be right for them. We
Sure.
have calculators
Sure.
and all these things.
Okay.
So I think that's really, really big because, we need to make sure this is going to make sense for people. But the nice thing is, Trevor's educated and dealing with seniors, because that's one thing I'm going to say. Some of our listeners are children of our potential borrowers that need this support. And I think that's one of the biggest things. And we actually get a lot of referrals in from our clients to be like, my mom and dad need some support here. If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.